The revised estimate for US GDP came in at an annual rate of 2.1% in the second quarter. That's down from the first estimates of 2.4%, as a drop in exports offset the tick higher in consumer spending. For more on this is David Doyle, Macquarie Group Head of Economics, joining us now. So I want to get your takeaway from this revision as we try and understand the actual health of the economy and what this actually means for the Fed's job as they try and manage interest rates with this sort of data in mind.
Yeah, so this is a fairly modest revision. I mean, just down, 0.3 percentage points on an annualized basis to 2.1% versus 2.4% previously. And the underlying component suggests that, a lot of that was due to, or at least a hefty component of that was due to the pace of inventory building, which actually mechanically, could provide a boost to 3Q growth. So I'm not overly concerned about, the revisions that took place in terms of what they're suggesting about the pace of growth in the second quarter. But what I did find interesting is that we did get the first release of real gross domestic income, which is an alternative way of measuring output. And, historically over time has tracked real GDP quite closely. That came in at just 0.5%, so plus 0.5% on an annualized basis in the quarter. So suggesting that growth was a fair bit weaker. And that sort of continues a trend in divergence that's occurred over the last 4 quarters or so in those two measures. And it suggests to us that potentially the economy isn't as strong as what the headline real GDP numbers are suggesting.
How can that play into the mind of the consumer from your perspective, David?
Look, the consumer, we think, is poised for some struggles ahead. In large part, the gains that we've seen over the past year or so in consumption, they haven't been underpinned by strong real income growth. It's been more driven by a reduction in the savings rate, a reduction in the excess savings that had been built up during the pandemic. And as we look ahead, we think those are unsustainable sources of spending growth. As we look ahead to the coming quarters, there's challenges ahead. The pace of jobs growth is slowing. Credit availability is tightening for consumers. And then, of course, in October, student loan repayments are set to recommence. We think that'll only add to headwinds. So we actually think that consumer spending is set to slow ahead, and that could weigh on the growth outlook in the back half of 23 and into 2024.
And David, as you look at some of the stronger parts of the economy that are propping it up at the moment, what are the standouts for you?
Yeah, so there's 3 major standouts for us within business investment, and actually these 3, business investment had been an area of strength in the second quarter numbers, but a lot of that has been very concentrated. Manufacturing structures has shown phenomenal growth. A lot of that is related to the semiconductor industry and is coming on the heels of the CHIPS Act that was passed last year. Then you have transportation equipment, so aircraft, cars, like trucks, et cetera. That type of business investment has also been quite strong. And we think that really reflects supply chain healing. And then the third component, which interesting, tailed off a bit in the most recent revision, was software, which could be related to, AI spending. A bit unclear, though, in terms of what the mechanics are there. But those are the components that are really driving the business investment, which tends to be the most cyclical component of growth. We're skeptical on the durability of those components to drive business investment growth going forward.
To what extent is the GDP kind of calculus also kind of impacted by some of the weakness that we're seeing in other parts of the world, and most notably in the second largest economy in the world, in China? Yeah,
so there hasn't, I don't think that there's been much pass through directly from China into the U.S. economy. The U.S. is a largely, I would say, independent economy from that perspective. It has less trade outside of its borders than most other economies. And the trade that it does have, it tends to be with Canada and Mexico. It tends to be within those two components. The exports to China are fairly low. So I don't think that we've seen much impact yet on the data coming through from China. But that doesn't mean that it won't be forthcoming. You could see that in coming quarters ahead.
And David, as we look at the likelihood of a recession in the U.S. economy? I mean, some people are saying it'll be a soft landing. Others are saying, look, markets really aren't pricing in enough of a recession risk. Where do the estimates lie now?
Well, I think opinion on that is still, I think, pretty divided. I think what you've seen over the past number of weeks, at least up until the last couple of days, was a period of very strong U.S. data where the numbers were coming in well above the consensus forecasts, and you saw a big increase in the economic surprise index, reflecting that. What do we think that means for the recession risk? Well, I think what it means is that while the recession risk is still out there, the timing remains quite nebulous. It's very difficult to pinpoint when things might deteriorate. People have been, I think, revisiting the timing on things in light of that recent positive data over the past several weeks.
David Doyle, Macquarie, head of economics. Thanks so much for joining us here this morning, David. Appreciate it.
Anytime. Thanks for having me.